Hello, welcome to Capital Sensei. Today, we're diving into one of the most incredible stories in stock market history. We'll unpack the method used by a world-famous ballroom dancer with no financial background to turn about $36,000 into over $2 million in just 18 months during the late 1950s. We'll explore his unique Darvas Box Theory, his strict rules for buying and selling, and how his greatest disadvantage, being thousands of miles away from Wall Street, actually became his secret weapon. And as we always try to do, we'll be looking through the comments to answer your questions. So please, feel free to share your own experiences, ask anything that isn't clear, or suggest a topic you'd like to see covered. Your participation helps everyone learn and builds a stronger community of investors. Let's begin with the man himself, Nicolas Darvas. Now, Darvas was not your typical Wall Street guru. In fact, he wasn't a guru at all. He and his sister were an internationally acclaimed ballroom dancing duo. They were constantly on tour, performing in sold-out venues from Paris to Hong Kong. He was an artist, a performer, someone whose world was about as far from financial tickers and balance sheets as you can get. His journey into the stock market began almost by accident. In 1952, a nightclub owner in Toronto couldn't pay him his $6,000 fee in cash. Instead, they offered him $6,000 worth of stock in a Canadian mining company called Brilland. Darvas, knowing nothing about stocks and needing the money, reluctantly accepted. He promptly forgot about it and went on with his tour. A couple of months later, he glanced at the stock quotes in a newspaper and, out of pure curiosity, looked up Brilland. He was shocked. The stock had more than tripled in value. He was now holding nearly $19,000. Without a second thought, he sold it and pocketed a handsome, completely accidental profit. And right there, the hook was set. The ease of it, the sheer luck, it was intoxicating. He thought to himself, if I can make this much money by accident, imagine what I could do on purpose. This is a thought that has led many people to ruin, and Darvas was no exception, at least not at first. He started his serious investing career the way most beginners do, by listening to tips, rumors, and the so-called experts. He would listen to other investors, read the gossip columns, and follow the advice of brokers. He was essentially gambling. He'd buy a stock because someone said it was hot, or because a company was supposedly on the verge of a breakthrough. The results were predictable. He lost money. Then he lost more money. He was buying on hype and selling in a panic. He was an emotional investor, reacting to every bit of news and every market wiggle. He was playing the game on Wall Street's terms, and Wall Street was eating him for lunch. After a series of painful losses, he had a crucial realization. All the tips, all the advice, all the insider information was just noise. It wasn't helping him, it was hurting him. He was touring the world, receiving letters and telegrams from his broker, days or weeks late. By the time he got a hot tip, the party was already over. He needed a system that didn't rely on being plugged into the Wall Street rumor mill 24/7. This is where his story gets fascinating. He decided to blend two different schools of thought. First, he looked at the fundamentals of a company. He wasn't a deep-diving accountant, but he reasoned that the best stocks were usually tied to companies in growing industries, companies with rising earnings and exciting products. He started looking for businesses that had that spark, that potential for massive growth. This told him what stocks to watch, but the fundamentals didn't tell him when to buy. A great company can have a stock price that goes nowhere for years. So he turned to the technical side, focusing on just two pieces of information he could get anywhere in the world from a newspaper: the stock's price and its trading volume. He figured that the market itself, through the simple action of price and volume, would tell him everything he needed to know. He began to notice a pattern in the stocks that made big moves. Before a stock would shoot up dramatically, it would often trade within a fairly narrow price range for a while. It would go up, hit a ceiling, fall back, hit a floor, and then bounce back up again, over and over. It was like a boxer dancing around in a small ring before throwing a knockout punch. Darvas visualized this trading range as a box. The top of the box was the highest price the stock reached before pulling back. The bottom of the box was the lowest price it hit before bouncing up. The stock was essentially trapped inside this box, consolidating its energy. Think of it like a coiled spring. The longer it stays compressed, the more power it unleashes when it finally breaks free. This simple observation became the cornerstone of his entire system, the Darvas Box Theory. His strategy was to identify a stock that was moving from a lower box to a higher box. He wasn't interested in buying stocks that were falling or moving sideways in a long-established range. He was a momentum investor. He wanted to catch a stock just as it was beginning a powerful upward trend. So how did he do it? He would scan the stock market pages, specifically the list of new 52-week highs. A stock hitting a new high was a sign of strength. It was his first filter. From that list, he would investigate the company. Did it have strong earnings growth? Was it in a leading industry? This was his fundamental check. If it passed both tests, he would watch it closely. He would wait for the stock to set the top of a new box. Let's say a stock hits a new high of $50, then pulls back. $50 becomes the potential ceiling of a new box. Then he'd watch it trade for a few days. Let's say it drops to $45 and then starts climbing again. $45 becomes the floor. The stock is now trading in a 50 by 45 box. Now, here's the critical part, the buy signal. Darvas would not buy the stock while it was inside the box. That would be guessing. Instead, he would place a buy stop order just above the top of the box, say at $50.50. A buy stop order is an instruction to your broker to buy a stock only if it reaches a certain price. He also had one more crucial rule for his buy signal. The breakout from the box had to happen on high trading volume. Why? Because volume is like the fuel in the rocket. A price breakout on low volume is often a fake out, a little blip that quickly fizzles. But a breakout on heavy volume, much higher than the stock's average daily volume, suggests that large institutional investors are piling in. It shows real conviction and power behind the move. So the stock is trading in its box. Darvas has his buy order waiting just above the ceiling. If the stock breaks through that ceiling on high volume, his order is automatically triggered and he's in. He has successfully caught the stock right at the beginning of its next potential upward surge. He's on board the moving train. But what if he's wrong? What if the breakout is a dud and the stock falls right back down? This is where the true genius of his risk management comes in. The moment his buy order was filled, he would immediately place a stop-loss order. And where would he place it? Just inside the box it had just broken out of. So, if he bought at $50.50, he might place his stop-loss at $49.50. Think about what this does. It defines his risk on the trade from the very beginning. He knows, before he even enters, the absolute maximum amount he can lose. If the breakout fails, he is automatically sold out of his position for a tiny, manageable loss. He called this protecting his downside. He wasn't trying to be right 100% of the time. Nobody is. He was trying to make sure that when he was wrong, it cost him very little. This disciplined use of the stop loss is what separated him from the gamblers. He never held on to a losing stock, hoping it would turn around. Hope is not a strategy. The moment a stock violated his rules and fell back into the box, he was out. No emotion, no second guessing. The system made the decision for him. Now, Let's talk about what happens when he's right. The stock breaks out of its first box and starts to climb. It might go from $50 to $60. Then it will often start the process all over again. It will form a new, higher box. Maybe it will hit a high of $65, pull back to $60, and then trade in that range for a while. Darvas saw this as a confirmation of strength. The stock was taking a breather, consolidating its gains before the next leg up. What did he do? He would move his stop-loss order up. He would raise it to just below the floor of this new box. So, his stop-loss might move from $49.50 all the way up to $59.50. Look at what he's just done. He has now locked in a profit. Even if the stock completely collapses from this point, his stop-loss will trigger and he will be sold out with a guaranteed gain. His initial risk is now completely off the table. He's playing with the house's money. This technique is called a trailing stop-loss, and it's one of the most powerful tools for letting your winners run while protecting your profits. But he didn't just move his stop-loss up. If the stock showed continued strength and broke out of this new, higher box on strong volume, he would often buy more shares. This is a technique called pyramiding. He was adding to his winning positions. He was doubling down on what was working and ruthlessly cutting what wasn't. This is the exact opposite of what most amateur investors do. Amateurs tend to average down. They buy a stock, it falls, so they buy more at a lower price, hoping to lower their average cost. They are pyramiding their losses, throwing good money after bad. Darvas only ever added to a position that was already proving him right by moving higher and higher. So you can see the whole system in motion. He buys on a breakout. He sets a tight stop loss. As the stock climbs and forms new, higher boxes, he trails his stop loss up behind it, locking in more and more profit. He might even add to his position on subsequent breakouts. He would stay in the stock as long as it kept climbing and forming these upward stepping boxes. When would he sell? Simple. He would be sold out when the stock finally broke its upward trend and fell through the floor of its most recent box, triggering his trailing stop loss. He never tried to guess the top. He knew that was impossible. He was content to ride the trend for as long as it lasted and get out when the trend showed clear signs of ending, capturing the majority of the move. This system is what allowed him to manage his portfolio while dancing in Calcutta or Tokyo. All he needed were telegrams with the daily high, low, and closing prices along with the volume. He didn't need news. He didn't need broker opinions. In fact, he came to believe that all of that was a distraction. His physical distance from Wall Street forced him to be disciplined and rely only on his system. It filtered out the emotional noise that causes so many investors to fail. Let's look at a real-world example of how he did this. One of his most famous trades was in a company called Texas Instruments. In the late 1950s, it was an exciting company in the new field of transistors. It passed his fundamental check. He noticed the stock starting to move, and he established his first box between $25 and $28. He bought on the breakout. The stock then moved up and formed a new box between $37 and $41. He trailed his stop up. It then broke out again, moving into the 50s, and he bought more. It kept climbing, box by box. Each time it formed a new, higher platform, he would raise his stop loss right below it. This single stock was a massive winner for him, and he rode it all the way up, letting the trend do the work and letting his trailing stop loss protect his ever-growing profits. Another legendary trade was in a company called Thiacol Chemical, which was involved in rocket propulsion systems during the space race. This was a classic Darvas setup, a revolutionary industry with huge growth potential. He saw the stock moving from box to box, 26 to 29, then 45 to 50. He kept buying on the breakouts and pyramiding his position. The stock eventually soared to over $160 a share. His biggest win, however, came from a company he initially knew nothing about, called Eel Bruce, a flooring company. It sounds boring, but the company had developed a new, cheaper method for manufacturing hardwood floors, and its earnings were exploding. The stock began to move. Darvas jumped in. The stock went on a truly legendary run, a move so sharp and fast that the New York Stock Exchange actually halted trading in it multiple times. Darvas, following his rules, held on as it rocketed upward, raising his stop-loss with each new box. This single trade was responsible for a huge chunk of his $2 million fortune, and he managed it all through telegrams, following his mechanical system without emotion, even as the exchange itself was panicking about the stock's volatility. It's important to understand the philosophy behind all this. Darvas called his approach being a techno-fundamentalist. The fundamentalist part of him identified great companies in booming industries. The technician part of him used the boxes and volume to time his entry and exit with precision. It was a perfect marriage of what to buy and when to buy. He had a few other ironclad rules that are worth mentioning. He avoided cheap penny stocks, believing that the real money was made in high-quality, market-leading stocks that were already priced high and going higher. He reasoned that a stock priced at $50 was there for a reason, and if it had the momentum to go to $100, that was a much better bet than a $2 stock that might go to $4. He also learned to completely ignore tips from brokers. At one point, he even used a broker who was deaf and mute, so he wouldn't have to listen to his opinions. All he wanted was execution of his orders. This might sound extreme, but it highlights his core belief. You need a system you can trust, and you need to filter out all the external noise that can cause you to doubt that system. So, the big question is, can this method still work today? The market is very different now with algorithmic trading, instant information, and global interconnectedness. Is the Darvas Box Theory just a relic of a bygone era? Well, yes and no. A direct dogmatic application of his exact method might be challenging. Modern volatility can create more fake-outs, where a stock briefly pops out of a box only to fall right back in. But the core principles behind his success are not just relevant, they are timeless. They are, in fact, the bedrock of many successful trading strategies today. First, the principle of momentum investing. The idea of buying strong stocks that are getting stronger is a valid and powerful strategy. Many quantitative funds are built on this very factor. Stocks that are making new highs do have a statistical tendency to continue to outperform, at least for a while. Second, and perhaps most importantly, is his ruthless approach to risk management. The idea of defining your risk beforehand with a stop loss and cutting your losses short is non-negotiable for long-term survival in the markets. Most traders fail not because they can't find winners, but because they let one or two big losers wipe out all their gains. Darvas solved this by making small losses a mandatory part of the system. Third, the concept of letting your winners run by using a trailing stop loss is how you generate massive returns. The biggest profits don't come from taking quick gains. They come from having the discipline to stay in a powerful trend for months or even years. The trailing stop allows you to do this with peace of mind, knowing your profits are protected. And finally, his philosophy of combining fundamentals with technicals is incredibly powerful. Today, investors have access to amazing screening tools. You can scan the entire market in seconds for companies with, say, over 25% annual earnings growth that are also trading within 5% of their 52-week high. You can screen for exactly the type of techno-fundamental setups that Darvas had to find by hand. The modern investor can build a Darvas-style system with more precision than he ever could. You can use charting software to draw the boxes automatically. You can set up alerts for breakouts. You can place complex conditional orders that link your entry to your stop loss automatically. The tools are infinitely better. However, the one thing that hasn't changed is human psychology. The fear and greed that drove the market in the 1950s still drive it today. The temptation to listen to a hot tip on social media is the modern equivalent of Darvas's broker telegrams. The urge to panic sell during a market dip or get greedy at the top is as human as ever. This is why Darvas's greatest lesson might be a psychological one. His success was forged in isolation. Being away from the daily churn of Wall Street forced him to develop and trust a logical, unemotional system. For the modern investor, this means you have to create your own isolation. You have to turn off the financial news channels, ignore the talking heads, and step away from the forums filled with hype and panic. You need to have a plan before you enter a trade. Know your entry price, your exit price for a loss, and your strategy for taking profits. Write it down. Then simply execute the plan. The market will do what it's going to do. Your job is not to predict it, but to react to it based on your predefined rules. That's what Darvas did. He wasn't a fortune teller. He was a brilliant reactor. His story is not about a magical, can't-lose formula. He had losing trades. He would often get stopped out for small losses multiple times before catching a big winner. He estimated that about half of his trades were losers. But because his wins were many, many times larger than his small, controlled losses, the math worked out spectacularly in his favor. It's a game of probabilities, not certainties. The journey of Nicolas Darvas, from the dance floor to a multimillionaire investor, is a testament to the power of independent thought, rigorous discipline, and intelligent system design. He proved that you don't need a degree in finance or a seat on the stock exchange to succeed. What you need is a sound method for identifying opportunities and, more importantly, an unbreakable set of rules for managing your risk and your emotions.